All right, part two of the Social Security Trustees report for 2018. So let's just dive right into this. And don't forget, subscribe down below, my friends, and thumbs up and comments are always welcome. So don't forget to comment and give me a thumbs up and subscribe. All right. So we left off at part one with the HI, which is hospital insurance, i.e. Medicare Part A. Now we're going to talk about the supplementary medical insurance, SMI, which is Part B and Part D. For SMI, the trustees project that both Part B and Part D will remain adequately financed into the indefinite future because current law provides financing from general revenues and beneficiary premiums each year to meet the next year's expected cost. Interesting. Beneficiary premiums are being used to help finance Medicare Part B and Part D. Who would have thought? Now, Part A, there are no premiums. It's free, which is why Part A is going to be destitute come 2026. So just let me go back here. The HI fund, again, fails a test of short-range financial adequacy as its trust fund ratio is already below 100% of annual cost and is expected to decline continuously until it's depleted in 2026 because there's no premiums going into it. However, HMI, or SMI, supplementary medical insurance will not. It is funded adequately indefinitely because of the premiums. All right. So, however, the aging population, rising healthcare costs cause SMI projected costs to grow steadily from 2.1% of GDP to 3.6. So even though it's adequately funded, the projected cost of that will basically double between now and 2092. And that just means your premiums are going to increase. General revenues will finance roughly 3/4 of SMI cost. Again, that's your Medicare Part B and Part D. And premiums paid by beneficiaries will finance almost all the rest. Okay, so the trustees report. Okay, let's keep going down. I want to keep going down here. All right, let's keep going. Conclusions. Lawmakers have many policy options that would reduce or eliminate the long-term financing shortfalls in Social Security and Medicare. They should address these financial challenges as soon as possible. Taking action sooner rather than later will permit consideration of broader range of solutions and provide more time to phase in place of changes. All right, let's keep going down because a lot of other stuff I want to talk about here. So bear with me, my friends, because I want to talk again. I highlight all this stuff. Okay. Right here. You ready? Here. Table 2 shows payments by category for each trust fund. All right. So the OASI, that's your Social Security retirement income, had set basically $800 billion of benefit payments, $806 billion of benefit payments. All right. Your disability insurance only had $145 billion in payments in 2017. Your hospital insurance, your Part A, had 296, we'll just say 300 billion. And then your SMI, your Part B and Part D had 413 billion. So if you take your hospital insurance plus your Part B and Part D, that's going to give you $700 billion that was paid out by Social Security, CMS, the Center for Medicare and Medicaid Services. Your disability and your Social Security retirement income had $950 billion paid out. You see where the 42% of the GDP is coming from right there? Because remember, 42% of federal gross revenue is used to pay out to these benefits right here. It's crazy. Now, income by source. I wanted to point this out. Social Security retirement income. Taxes represent $36 billion. Taxes on your benefits, not payroll taxes, which is pretty significant. I mean, hugely significant. But taxes on your benefits represent $36 billion of the source of income for Social Security retirement. Taxes on your DI. So remember, OASDI, that's your retirement and Social Security disability income. Or insurance, represent $2 billion. So between OASDI, taxes on your benefits, that's for retirees right now who are receiving either disability or Social Security payments, retirement payments, $38 billion of their benefits that they receive they had to pay back in taxes. The HI, hospital insurance, another $24 billion was paid on taxes for your hospital insurance. And I will talk about that. Beneficiary premiums. All right. So the SMI, that's your Part B and Part D, $97 billion worth of beneficiary premiums to finance your Part B and Part D, and your beneficiary premiums are $3.5 billion on your hospital insurance. Now, what is the taxes that funds your hospital insurance? Anyone want to guess? Yeah, it's the taxes you pay because you have too much income, essentially. So that's a lot of taxes that you're paying there, not just for all, but all of it. You're paying taxes on your premiums because you have too much income. You're paying taxes on your benefits because you have too much income. We're talking hundreds of billions of dollars. All right, so let's keep going down. I thought that's pretty interesting, actually. Where the money comes from, it's coming from the taxes on the benefits that you've already paid taxes for, is ultimately where I'm going with that. Social Security's annual cost as a percentage of GDP is projected to increase from 4.9% in 2018 to 6.1% in 2038, and then decline to about roughly 6% going forward. But that's just Social Security. All right, that's not Medicare. Medicare rises from 3.7% in 2018 to 5.6% in 2035, due mainly to growth in the number of beneficiaries. More people getting older and they're living longer. There's more beneficiaries on taxing the system. And we don't see the chart here, but we'll come back to the charts a little bit. I want to show you this one chart in particular, which didn't copy over here well. It's important to understand that the two programs have different taxable payrolls. HI, hospital insurance, Part A, payroll tax is 25% larger than that of OASDI. So HI, that's your hospital insurance. That's your Medicare tax that you're paying on your payroll. And we'll show you how that's broken out. It's 25% higher than the tax on your Social Security, all right? Because the HI tax is imposed on all earnings, while OASDI is only applicable to a maximum of $128,400, which is adjusted for each year. Thus, percentages in Chart B are comparable within each program, but not across programs, because your hospital insurance, your Part A, is taxable on every single dollar of income you make, whereas your OASDI stops at $120,400. Projected Social Security costs grows to 16.83% of taxable payroll in 2039 and to 17% of taxable payroll in 2092. The projected Medicare health insurance cost, the hospital insurance cost rate rises from 5% taxable payroll to 5.1, rises to 5% in 2050. The HI income rate, this is huge. The hospital insurance income rate rises gradually from 3.36% to 4.41% due to the Affordable Care Act's increase in payroll taxes for high earners that began in 2013. So don't hang in there. In 2013, individual tax return filers with earnings above $200,000 and joint return filers with earnings above $250,000 pay an additional 0.9% tax on earnings above these thresholds. An increasing fraction of all earnings will be subject to the higher tax rate over time because the thresholds are not indexed for inflation. By 2092, an estimated 79% of workers will pay the higher tax. That is from the Social Security Trustees report. That's not me. How do we see this? Oh, we have it, but the same thing with the Social Security taxation of Social Security benefits. It was not indexed for inflation. So initially, I don't make $200,000 if I'm single, or $250,000 if I'm married filing jointly. No, same thing they did with Social Security taxes on Social Security benefits in 1983. The exact same doggone thing. However, because it's not indexed for inflation, the trustees say 2092, 79% of workers will pay a higher tax on their premiums for the health insurance because it's not indexed for inflation. If that doesn't make you mad, I don't know what will. Let's see if we have anything else in here. Unlike HI and OASDI, SMI, that's your Part B and Part D, does not have a trust fund structure with the surpluses accumulated from prior years. General revenues finance 75% of it, and the rest impose an immediate cost on the unified federal budget, and the rest come from your premiums that you pay as a beneficiary. And let's just look real quick. If full benefits are to be maintained for both Social Security and Medicare by 2042, the combined OASDI and HI financing gap plus the supplement, plus Medicare Part B and Part D, general revenue demands will equal 4.4% of GDP, which is more than double its 2018 share. The OASI trust fund is financed. We already talked about that. All right, so remember the different trust funds. And I think we got a chart here that I want to show you that shows you, it's down here. Bear with me just a second. That actuarial balance is not an informative concept for the SMI. That's Part B and Part D, remember, supplementary medical insurance program, because federal law sets premium increases and general revenue transfers on the levels necessary to bring SMI into balance. So the idea that you're not going to see increase in your premiums or even taxes you're going to pay more if they need to charge you more. All right, so here's what I want to show you. I think, maybe not. I was going to show you how they got how Social Security, right here. Yeah, how are Social Security and Medicare financed? So OASI is 5.01% of your salary is paid in taxes to fund the Social Security retirement and survivor benefits, and another 5.015 from your employer. So a total combined amount of roughly 10% of your income goes to finance Social Security retirement. So don't tell me it's a welfare program. It's not. 10% of your money is going to fund that. For disability insurance, Social Security disability insurance, 1.185 from you and another 1.185 from your employer. So 2.37% of your salary is being taxed to finance the Social Security disability. So your total taxes is 12.4% for OASDI. So the problem I always hear with that, when people say, oh, we should make it unlimited, that'll be an extra 12.4% taxes on every single person, self-employed, non-self-employed. So if they get rid of the caps on Social Security funding, that is going to be an extra 12.4% premium or tax raise on everybody, because that simply just says we're going to get rid of the cap. And that's your employer and that's you as well. And if you're self-employed, that's 12% that you're paying right out of the gate. Hospital insurance is 1.45 on both sides. So that's 2.9 total, both sides being the employer and the employer and you. And so essentially 7.65 of all your income is going to fund these four different things: Social Security retirement benefits, Social Security disability benefits, and then health insurance Part A. Now, we're not doing health insurance Part B or Medicare insurance Part B and Part D because it's funded as a beneficiary when you get claims. All right, taxation of Social Security benefits is another source of income for the Social Security and Medicare trust funds. Beneficiaries with incomes above $25,000 or $32,000 when married couples filing jointly pay income tax on up to 50% of the benefits, with the revenues going to the OASDI trust funds. This income from taxation benefits made up about 4% of Social Security's total income. 4% of Social Security's total income is made from taxes on your benefits, of which you already pay tax on. All right, so let's see. Pay income tax of 85% if you make a little higher threshold, i.e. the provisional income, with the additional revenues going to the Medicare trust fund. This income from taxation of benefits is made up of 8% of your hospital insurance trust fund. So again, your taxes pay a significant amount into Social Security and Medicare trust funds. Payments from the general fund finance about 70% of the SMI. That's your Part B and Part D, with the most remaining costs being covered by premiums. All right, so that's all I want to talk. Oh, wait. Oh, there are also income-related surcharge, premium surcharges for Part B beneficiaries. We talked about that, whose MAGI, modified adjusted gross income, exceeds a specific threshold. In 2018 and 19, the threshold was $85,000 for individual tax returns and $175,000 for married filing jointly. Income-related premiums, IRMA, range from $187.50 to $428 per month. That's exactly right. So you can't say you weren't warned, my friends. You cannot say you weren't warned. The Social Security system is in a world of hurt. It's not going bankrupt, but they're certainly going to raise money someplace. They're going to do it from taxes. Let me just show you real quick. This will show you the chart right here. I don't care about that. I don't care about that. I mean, I do care right here. Chart. OAS, DI, and HI. So OAS, I is Social Security retirement, DI is disability, Social Security disability income, and HI is hospital insurance. What you see here is historical. Here's the 2034. So here's the trust fund. It's done great. 400% of it's funded up until, I guess that's 2012 or something like that. In 2034, it's gone. There's no more trust fund. Here's your HI, your hospital insurance, your Medicare Part A, and that's gone in 2028, 2026. And then here's your DI, Social Security disability income, that's gone in 2032. So not good news on the horizon. You better be preparing because you're going to pay more in tax if you have too much income to declare. That's just all there is to it. So do use Social Security as part of your retirement projections? Absolutely. If you want to reduce it to 75%, that's fine. But start planning on how you can reduce your taxable income because it's only going to affect how much you pay to taxes on your premiums and on your benefits as you go forward because the money just isn't there. They're going to get the taxes and they're going to get it from you if you're not careful. Don't forget to subscribe. If you like what you see here, comments, questions, and concerns, thumbs up are always welcome. And we'll see you next time at the Heritage Wealth Planning YouTube channel. Thanks, guys.